Hi, Crystal.
Hi, Serena. How are you? One of the ways that you can gauge when it's probably time for you to consider another business structure, like right now, if you're operating as a sole proprietorship, or you may be heavily engaged in a business that you may incorrectly still assume it to be a hobby and may not even be taking advantage of the deductions and things that you can do on your tax return. You can look at just the overall profit and net income of the business, what you anticipate. If you are planning on having a number of contracts that are going to come through for you that are going to be pretty lucrative, that you're anticipating that you're going to really not have a whole lot of expenses that you can write off against that money, and you want to make sure you're not going to owe, that's possibly a good time for you to have that discussion with your tax professional and make sure that deciding to incorporate is not going to be a great option for you. One example that comes to mind when we're talking about business structures that really made a very strong impact on my client's overall tax liability was a situation where he originally was filing as a sole proprietorship but had incorporated a business that he was not necessarily keeping active or operating under. And we were able to actually make use of that corporation and roll that revenue up under his corporation, and it saved him over $9,000. So business structures definitely can make a difference, and it's so important that when you work with your tax professional, whomever you may work with, that you do not allow them to give you a one size fits all boxed in answer and advice for your situation, because everybody's situation is different. A lot of people, for instance, use that scenario. Oh, most businesses, when they're in the startup phase for the first 5 years, they anticipate a loss. That's not always going to be the case. If you're a consulting company, you may have a huge amount of profit because you may only need a laptop and some office supplies to provide your services. So that means that you have a very large profit margin that if you're operating as a sole proprietorship, it's going to give you a very high tax liability. Whereas if you operated that same consulting firm as an S Corp, you would save thousands right off the bat.